Hello, everybody. Welcome to today's show. My name is Spencer Welsh. Thank you so much for joining us here today. We have a good show and an important show, as always. So let's get into it today. We are talking about what happened at the Federal Reserve. This is probably one of the most important vehicles of monetary policy you will see in quite a long time. The Fed has tremendous influence over very important parts of your life, probably one of the most singularly powerful political organs that you do not know about. And for that reason, how powerful it is also one of the least democratic institutions. Notice how all the ones that we get to control can't seem to do anything. Looking at you, Supreme Court and Congress as well. Also, we're going to take a look at the last time interest rates skyrocketed in this way, the largest inflation or interest rate raise since the lead up to the Great Recession. Also, we're taking a look at the the legacy of Paul Volcker, how that happened the last time. Ross Douthat's reaction to the news in the New York Times, and we will break down Joe Biden's controversial trip to Saudi Arabia. Look at what exactly is going on there, and how in American foreign policy the kingdom always seems to win. All right, ladies and gentlemen, let's get right into it today. We are starting with the latest news on inflation. And we are really seeing a pretty interesting situation. This is what Fed Chairman Jerome Powell was saying today as he decided to raise interest rates 0.75%.
Target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. The American economy is very strong and well positioned to handle tighter monetary policy.
Yes, that's Jerome Powell, the Fed chair, and he was also one of the rare people who stayed on from the Trump administration all the way through to the current day. And so with that being said, it is a very, very significant move, the biggest interest rate move since 1994, to tackle inflation here. The big rate increase, which markets had expected, had underlined that the Fed officials are serious about crushing price increases, even if it comes at a cost to the economy. So you're going to see these price increases, but, you will see little support for and the people, the price increases are coming, and hitting most appropriately, hitting hardest, people who are just not able to pay them. And what we're seeing now from that is the economy is going to tighten for the people who have to pay, who are also going to be burdened or hit the least by inflation. So it's not going to be a very good situation at all. In a sign of how the Fed expects its policies to affect the economy, officials predicted that the unemployment rate would increase to 3.7% this year and 4.1% in 2024, and that growth would slow notably as policymakers push borrowing costs sharply and choke off economic demand. So that is going to be, literally a, kind of forced recession. And so, of course, we get the quote from Jerome Powell, "Oh, we're not trying to induce a recession." So, I feel like if you're saying something like that, and that question's already being asked, to me, that's already a bit of a warning sign there, to say the least. And so the Fed's policy rate is now set in a range between 1.5 to 1.75, and policy makers suggested, this is the interest rate there, for the Fed is just generally is 1.5 to 1.75 after that increase, and the policymakers suggested that more rate increases will be coming. The Fed, in a fresh set of economic projections, penciled in interest rates hitting 3.4% by the end of 2022. That would be the highest level since 2008, and officials saw their policy rate peaking at 3.8% at the end of 2023. So that's probably about, that according to these projections, that is the highest they will need to go, a 3.8% interest rate. So they're looking to pretty much double, more than double where they are now by the end of the year. So the Fed officials also newly indicated what they expect to cut rates in 2024, which is a sign that they think the economy weakens so much that they can reorient to their prior policy approach. And so we're seeing like a weakening of the economy here, and that is going to be, that I think the appropriate thing is looking at where that cost is going to be coming, and that is going to be coming most likely, because if you look at where this has happened in the past, this happened a lot in the 1980s, it pretty much systematically was very, very instrumental for, financialization, huge amount of mergers and acquisitions. People were able to do things. The bigger players in the economy were able to do things way more efficiently than they would have otherwise. And it also took away from a lot of labor power as well, as kind of a knock-on effect. So underlining that, policymakers cut a sentence from their post-meeting statement. They predicted that inflation could moderate while the labor market remains strong. So not going to happen. The labor market, because that was the big thing. This was the big thing that we all kind of knew was coming when we heard these stories about the tight labor market, the fact that there are, a lot of more work, jobs are desperate for workers. That is a big underlying thing here. We saw these companies, slowly forcing to maybe, begin to increase wages here because of just the increased money supply. But now we're seeing with this policy move, they won't have to, and the status quo will remain. So that is a big, and very and they can just literally snap their fingers. It'll be a second or third order kind of knock-on effect that will not really be noticed by a lot of people, but that is the effect that it will have. So a hint that they may. So this little change to the statement, the policymakers cutting a sentence from their post-meeting statement that it predicted that inflation could moderate while the labor market remains strong. They got rid of that. So they hint that they believe they may have to slam the brakes on job growth to wrestle inflation under control. So it's going to be a market that was at this point very, very beneficial to workers. They had a lot of options. Those options were really desperate for a lot of workers, and they were willing to maybe pay them a little more, give them a little bit more in benefits, and they just had more job options. That is something that will most likely be on the decline. So inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures, the Fed reiterated in the post-meeting statement. So one official, the president of the Federal Reserve Bank of Kansas City, Esther George, voted against the increase, though George has historically worried about high inflation and favored high interest rates. She would have preferred a half-point move instead of a 0.75-point move. So until late last week, the markets and economists broadly expected a half-point move. The Fed had raised rates by a quarter point in March and half a point in May, and signaled that it expected to continue moving up that pace in June and July. But central bankers have received a spate of bad news on inflation in recent days. The consumer price index picked up 8.6% in May from a year earlier, the fastest pace increase since late 1981. This could get runaway very fast. Here's what they're worried about. As monthly inflation rate remained brisk even after stripping out food and fuel prices. So those are two big things that are driving a lot of this. And most likely they're having these kind of, knock-on effects where people are just not able to, buy certain things and be able to, go out in the market as much as they would like because of, their pocketbooks being squeezed, And, of course, you're seeing a lot of, global chaos with a lot of different things around the world. And in almost all these instances, you're seeing, like, for example, cars going up in price. There's major, for example, chip shortages, like supply chain issues continue to be a major problem all throughout the globe. We saw the lockdowns taking place in China. Of course, the wars going on in Russia and Ukraine severely impacting, this gas and food production. So, while the Fed's preferred inflation gauge, the personal consumption expenditures measure, is slightly lower, it remains too hot for comfort, and as consumers are beginning to expect faster inflation in the months and even years ahead, and also are more pessimistic than ever about the nature of the economy, based on survey data, this is kind of a bit of a worrying development. Economists think that expectations can be self-fulfilling, causing people to ask for wage increases and accept price jumps in ways that perpetuate high inflation. So, that is the biggest thing, because inflation is something that for a long time, and for a long, it was essential to American monetary policy. They viewed that as more important than, you having a job, because the thing is, high inflation necessitates higher wages, and then, possibly, that would cause less profit margins, or, it would make it harder for people to keep their profit margin the same as they're trying to do, which creates a whole other kind of kettle of fish, to say the least. The central bank, they've been trying to set this economy onto a more sustainable path without pushing it into a crushing recession that costs jobs and tanks growth. But they're going to say, we got to do it anyway. So policymakers have been hoping to raise borrowing costs and tamp down demand just enough to bring supply and demand into balance without inflicting major pains. But as price increases become more stubborn, achieving that so-called soft landing becomes more of a challenge. The central bank's interest rates increases are already filtering out into the broader economy, pushing up mortgage rates, and the housing market is beginning to cool down. Demand of other consumer goods is showing signs of beginning to slow as money becomes more expensive to borrow, and businesses may cut expansion plans. So, so that is something that could be a little more interesting. And the people who, by that measure, though, this is something to keep in mind on the other side of this, the people who are going to be able to expand more, they're going to be, your bigger companies, they're going to be able to push more and into your smaller companies who are going to be able to afford to borrow, these bigger companies will, at that higher interest rate. So, yeah, the goal that they're trying to do here, though, is to weigh on demand enough to allow supply, which remains constrained amid global factory shutdowns, shipping issues, and labor shortages. Keyword there, labor shortages in the end, to catch up. So pretty much what they want to do here is they want to get people calmed down, make it a little bit make it a little bit harder to buy things, make it less fun to buy things, even though, or at least make major economic moves that would require loans and interest and stuff like that. Because those rates will be going up as people get their workers in order. These big companies, these big factories, and the supply chain, and pretty much capitalism as we knew it pre-pandemic gets more back in order. But curbing demand without tanking growth is difficult to do, especially because consumption makes up the biggest part of the American economy. And essentially, frankly, it is the only viable part right now of the American economy. It is what we serve, is the purpose we serve in the global economy and have served since, the completion of really deindustrialization. Markets increasingly fear the central bank's policy will cause a recession, which I think, not a bad guess at all. Stocks have been plummeting and bond market signals are flashing red as Wall Street traders and economists increasingly expect that the economy may dip into a downturn, perhaps next year. All right, so it's also important here to take a look at something that we kind of knew, or take a little bit like a history look into the last time we saw a really sharp raise in interest rate, which was the 1980s and Paul Volcker, specifically the Volcker Shock, as we switch now from the New York Times to Jacobin Magazine. So through the Volcker Shock, as it is now remembered, the Federal Reserve didn't just opt for the recessionary approach. It did so in the harshest way possible. Instead of adjusting short-term interest rates, which the Fed could do with some precision through conventional measures, Volcker, who was, again, the Federal Reserve Chairman, Paul Volcker, at this time, in the 1980s under Jimmy Carter, by the way, a lot of parallels to Biden and Jimmy Carter, to say the least, Volcker took the radical step of contracting the total money supply, which effectively translated into the central bank encouraging interest rates to soar without any guard for their deleterious effects, tamping down growth and things like that. Looking at the Powell approach here, and it seems like they're trying to go a little bit more slowly, which I think should be some cause for comfort. But Volcker, took the radical step of contracting the total money supply, which effectively translated into the central bank encouraging interest rates to soar again, without any regard for what they might do to normal people. In practice, it involved the Fed using its power to limit the growth in commercial bank deposits, which in turn reduced the amount of lending and, by extension, the amount of money in circulation. That was a page right out of Milton Friedman's monetarist textbook. Technical as it sounds, it was all decidedly illogical. Following years of compromise and a flinching from a head-on attack on inflation, it was time to act and send a convincing message to the markets and the public. Said Volcker. Interest rates, already above 10% when he took office in August of 1979, climbed above 17% within 6 months. At the start of 1981, they exceeded 19% and would not fall to a single-digit number for almost 2 years. Over the quarter century before Volcker's term began, the benchmark federal funds rate had averaged just under 5%. The expected recession ensued, with unemployment surging to 11%, still the highest on record since the Depression. And again, pandemic doesn't have that beat, I don't think. Maybe even for like a week or two, but the pandemic does not have that beat. It's going to be interesting. I think the important thing to watch is how hard, and how aggressive they are in this move here, because I think there's a lot of different ways you could do it. You could do the Volcker shock, or you could do, I think, because Powell has been much, much more careful with the economy, not trying to jump it up and jump it down or keep it up for too long. They're already, they're making these plans to lower it down in a way that Paul Volcker definitely did not do at that time, which is, I think, a more reassuring if you look at the consequences that Volcker's actions had. So, again, this was not an ordinary cyclical downturn. It resulted in a wave of plant closures, as harder for big businesses to kind of expand or businesses to make these kind of big economic moves, hastening the deindustrialization that had already begun to devastate United States cities. Between 1976 and 86, the trade deficit increased almost 23-fold, a trend to which the extremely strong dollar that accompanied the high interest rates contributed to in no small part. Volcker does remember that ordinary people were not happy about his actions. In April 1980, the National People's Action Group demonstrated outside the Fed's Washington headquarters. At one point, farmers encircled the building with tractors, and home builders ran a letter-writing campaign on sawed-off 2x4s. So, they were really not happy about that from all parts of the economy. The AFL-CIO president, Lane Kirkland, for his part, pleaded that Volcker worry about inflation only after the economy recovered from, again, the shock that he kind of created there. But those complaints fell on deaf ears. And that was because Volcker really had no reason to listen. As Leo Panitch and Sam Gindin have put it, the Volcker shock was, quote, not so much about finding the right monetary policy as shifting the balances of class forces in American society. People were supposed to be pissed. I think because we are already seeing some pretty significant differences on this front. Again, this is another article in Jacobin here. By embracing a restrictionist monetary policy, Volcker and the Fed increased interest rates and in turn changed how capitalist markets for labor operated. With the support of the state and finance, central bankers intentionally pressured firms to cut their labor costs by changing market dynamics, weeding a workers' capacity to make and win demands. So this was much more, I think, ideological, at least on the surface, from what we can see from Jerome Powell. Maybe this is kind of going to be the end of effects, whether they like it or not, or maybe it is what they're trying to do. We don't even know, but I think it's definitely worth watching and looking back at the history. So this history here underscores a basic feature of capitalism. The history, class struggle, it's always going to be political, but it will always be constrained by political economy. The story begins with inflation, a silent thief. American inflation has typically taken off during wars, but in the inflation of the 1970s, it was kind of a new force, rising from negligible in the mid-1960s to double digits by early 1980s. Inflation posed a major obstacle for the capitalist growth models and American dominance on the world market. It became the defining macroeconomic event of the post-war period. Inflation destroyed the Bretton Woods system of exchange rates, taxed capital stock, bankrupted the thrift industry, undermined government security, eroded wealth and purchasing power, and weakened American firms vis-a-vis their foreign trading partners and hindering foreign investment. In 1971, the series of measures known as the Nixon Shock had decoupled the value of the dollar with gold, turning into a free-floating currency. With the fixed exchange rate cut, the dollar bore the heavy burden of performing well relative to competing currencies like the pound, franc, mark, and yen. And now, returns on assets held in the dollar would in part reflect changes in the value of the currency itself. This worried Wall Street investors, and with inflation on the rise, 1974 Federal Reserve Chair Arthur Burns increased interest rates and tightened credit. This contributed to a recession, but also helped reduce inflation to 5% in 1976. In the year of the recession, however, in 1974, that was the big turning point. Wages also stopped rising with productivity. That was, we see all these graphs, like, look at how productive workers are, and look at how, wages are just not keeping up with that. The price of the bullion has been always a key indicator for the Federal Reserve, the gold bullion. An increase in the price of gold signaled to central bankers a decline in Wall Street confidence in the dollar, while a decrease expressed greater confidence in the currency. Gold prices fell 50% in the 20 months following Burns' intervention, but the macroeconomic fix to capital's inflation woes was short-lived for central bankers. Of course, Burns, the Fed chair under Nixon, was unsuccessful with that inflation, though. And, of course, by the beginning of 1977, inflation begins to creep up again. In 1978, the confidence barometer in Wall Street signaled major worries about the dollar. The price of gold had skyrocketed. Wall Street certainly had something to brood over, as America's currency was losing against its competitors, especially against the German mark. Again, so competing, with major firms, a big concern, obviously, for American capitalism, and something that they would have a greater interest in, or perhaps less so now, I guess, because of the just general globalization of the economy. But in terms of, for America's power as economic power, like a center of activity, it would be very important and probably detrimental if we were to see that kind of continued rise in currency and the decrease of price in the dollar. And that would be brought on by inflation. So that is I think a very interesting and important thing to look at. Just another one of these factors as we look back at the history. So financial investors understood that a weakened dollar was a source of volatility in international money markets, including according to Volcker, who reflected at once, as both a custodian of the state and representative of finance, our moral obligation to prevent the debasement of our currency coincided with our self-interest. Above all else, the members of the Economic Advisory Council and Volcker himself operated with a cost-push theory of inflation that specifically pointed to labor power as the driver. So cost push is when overall prices increase due to increases in the cost of wages and raw materials. So cost push inflation can occur when higher costs of production decrease the aggregate supply. And of course so these guys, they weren't saying, it was raw materials. It was a labor power. Labor is demanding too much, and they went about crushing it. I think these kind of policies, this kind of aggression, is something that we don't quite see yet from the Biden administration, but I don't think we should at all. Maybe it's not as transparent, but the effects could very much still be there. My name is Spencer Walsh. This is the Spencer Walsh Radio Network, and if you're listening to one of our podcasts, whether it's Newsflash, Hidden History, The Spencer Walsh Show, or something else, ladies and gentlemen, we have one simple request of you. Please be sure to rate us, subscribe to us if you like us, and leave us a comment, because just like all of you, sometimes we need that feedback in our lives, good or bad. We want to hear what you have to say. So please do those steps. Make SWR and content better. And thank you so much for listening. Very important there. Really do appreciate it if you could take the time to do those things. All right, we move on now to our next story. An interesting little op-ed here by Ross Douthat. As he writes, there are many things bad about the period of American politics between Donald Trump's escalator descent in the summer of 2015 and the arrival of the COVID pandemic. The the chaos, polarization, corruption, and hysteria are, the usual list, as I'm sure you have heard. But one notable thing about the period was the return of intellectual ferment and policy ambition. Effectively, both Trump and Bernie Sanders demonstrated that more things were possible in American politics that appeared in the case of in the case of the dreary mid-Obama era when not that much was going on. He also goes on to argue that what could really create the sense of new possibility, what helped Trump defeat the Republican establishment and lifted the Sanders campaigns in 2016 and pre-pandemic 2020, was a sense that America had more room to just spend money than the establishment in the Obama era believed. I think that's definitely true for Sanders, but, Trump, I think the idea that Trump was, pushing for more money spent as a central part of his campaign, I think is pretty dumb. When deficits skyrocketed during the Great Recession, not just Tea Partiers, but also a lot of respectable centrists assume there's real inflation and debt crisis risks on the horizon. In this landscape, Washington became obsessed with fiscal grand bargains, as Obama almost got rid of Social Security for one. But even, the thing was there, no inflation came, and the American economy chugged along below full capacity. As this became apparent, the green eyeshade spirit gradually dissolved, and socialism and populism took over for Simpson, Bowles Commission people and Paul Ryan's budgets. And I think this is a little bit dishonest here, because it acts like, we started spending big, we started doing crazy things. We did things like the bailouts for Wall Street. That cost an incredible amount of money. We did the tax cuts. That also was incredibly, detrimental. But in terms of big, at least deficit-wise, but in terms of big spending, especially big programs like the kind we saw in the Green New Deal, we have not seen anything close to that. Pretending that is the case, I think is just so dishonest. Like the fact that, Joe Biden's Build Back Better plan, the CARES Act plan, which was pretty much got sunk right into the economy. I don't think anyone would say that was a factor to inflation. So what are they going to point to? Like the infrastructure bill, like I forget the first thing that Biden passed when he first got in there, that also that had $1,200 checks to every American. Is that like the child tax credit? Is that the cause of all the inflation here? Like this major crazy, government spend. He acts like there's so much of a swing here in the other direction, and this is the kind of media, especially in a place like the New York Times, that will lay the groundwork for something more like a Powell Shock, who comes a kind of a theory of inflation. Or theory behind the cause of inflation that really talks about labor power and the need being a problem, and the fact that people need to be paid too much as the biggest cause of inflation, whether that be the government, whether that be corporations. This is the kind of media that will set up that very, very dangerous trend by a very influential figure like Ross Douthat in the New York Times. So in certain ways, the policy response to the pandemic was the apotheosis of this trend. Bipartisan spending bills, extraordinary spending levels, negligible concern about the deficit. I think everyone was concerned, throughout the whole time, especially in the second bill. And that's the whole freaking deficit concern is the reason literally why the other big spending bill that was 90% of Joe Biden's entire agenda didn't get passed. So that's why Joe Manchin objected to it. And Kristen Sinema. So that is a big, fat misleading right there, to say the least. And then at last, inflation made a comeback. And just like that, the era of free lunch policymaking came to an end. Except for the fact that, in the end of the day, nobody got a free lunch. I think that is the biggest thing here that Ross Douthat is working on. They got, some saltine crackers to get them through the pandemic. But in terms of any kind of material improvement, I think that happened with very, very few people in this country.
Hello, everybody, and welcome to our segment to tell you all about what's going on here on the Spencer Walsh Radio Network this summer. We do, as I'm sure you know, have a great lineup available for you. We, of course, start with our flagship show, Newsflash, all new Mondays, Wednesdays, and Fridays. Uncultured, irregularly back every Saturday with live music and sports analysis with my co-host for the summer, Bennett Laxton. Hidden History will be brand new every Thursday on a bit of a hiatus, but will return shortly. It's the summer of podcasting. It's the summer of sounds. All you got to do is just keep listening. wherever you get your podcasts, always here on the Spencer Walsh Radio Network. It's time to move now into our last story today. As you may have heard, Joe Biden is on a bit of a trip to Saudi Arabia, and an interesting case here by Jack Crosby in the Discourse blog saying, this is the most natural thing that he has done. Diplomatic decision. I think it's something that, is certainly fair. Every single president has been forced to, in some way, cozy up to Saudi Arabia at one point in their administration. The limits of the United States relationship with Saudi Arabia have yet to be established, and it seems unlikely to me they ever will. 2 decades ago, hijackers who have been plausibly linked by FBI documents declassified by the Biden administration, among other evidence, to extremely high levels of the kingdom's government, crashed 2 jet planes in the Twin Towers, triggering an overwhelming U.S. response that culminated in the invasions of Iraq and Afghanistan, and military intervention. By the way, 2 countries that had literally nothing to do with the attacks, and military interventions in a dozen countries across the Middle East and North Africa, in the name of rooting out the actors and sponsors of global terror. It is not really particularly hyperbolic at this point to say that Saudi Arabia did 9/11 and the United States sat there and took it and then paid them for it. That's the facts. That's literally the facts. We went around with our swinging our arms in the air at every other Middle Eastern, literally every other country in the region, except for Saudi Arabia. We paid them for it. We sold them arms so they could do things like that to other people in Yemen. It's just clear as day. So it should come as no surprise then that the Biden administration is pursuing a reset of the American relationship with Saudi Arabia, the details of which would assumably be hashed out when Biden visits Saudi Arabia for a gathering of regional leaders in July. The trip was announced on Tuesday, and it represents a significant departure from Biden's 2020 campaign rhetoric, in which he promised to, quote, make them, in fact, the pariah that they are. Public outcry against the Saudi regime, which is and has been guilty of basically every human rights abuse you can think of, both inside and outside its own borders. It reached, obviously, a fever pitch when a team of Saudi assassins murdered Washington Post columnist Jamal Khashoggi in the Saudi consulate in Istanbul. The Trump administration, of course, largely shrugged off the provocation, which perhaps led to Biden's opportunistic bombast on the campaign trail early on. Early into the Biden administration, Politico reported it looked like that the president would keep the Saudis at arm's length, whatever that means. An arm that would quickly turn into come hither motion, an arm stretched. Sending an envoy to tell the crown prince and de facto head of state Mohammed bin Salman that he was very peeved at him, and would need to do some apologizing and a bit more wallpapering over the aforementioned human rights abuses. That's pretty much it, as the kingdom always wins. Nothing the Biden administration did in its time in power really materially affected any of the ways that Saudi Arabia continues to shape the Middle East or the world. The United States has continued to support Saudi Arabia's brutal war in Yemen, taking the kingdom's side with milquetoast rhetoric and continuing its pre-existing policies with only semantic shifts. We're now doing this for defense, but what is the defensive operation? The Saudis have pretty much let them claim anything as a defensive operation, so they're happy to help. The United States is. In January of this year, the United States made a bomb dropped by the Saudis that killed 80 people and injured over 200 civilians. What is the point? The kingdom wins. Nothing has changed. So, yeah. Politico reported that MBS's initial demands to Biden, including asking for no surprises when it came to delicate negotiations with Iran over a re-entry into the JCPOA nuclear deal. Congress has already pushed back against some of Biden's negotiating points, and it seems to me that the lives of millions of Iranians suffering under punishing U.S. sanctions are likely to be casually tossed aside between, especially if we see, Biden trying to get back in with the Saudis. The Iranian people will be the first to go as they continue to pay. If you think what we're paying is bad for food and medicine, try living in Iran. Let's just say that. These are the games that Biden is playing. These are literally the games that every single president, regardless of party, has played since 1945. No matter what he says about the Saudi regime now, it's clear whose interests will always come out on top. At least the Biden administration is finally abandoning the pretense that things will be any different. This is a time of crisis, and we need Saudi oil. The only question is how much we'll pay for it. That is Jack Crosby in the Discourse blog. A pretty good piece there, making some very good points about
the reality of the situation and how, as we know, the kingdom always wins.